Hello, I'm Steve Weisbart, and today I want to talk with you about inflation and its impact on the property casualty insurance industry. Inflation is an important topic in property casualty insurance because, of course, contracts collect money in and pay in dollars, and inflation is the price of everything. So if prices are rising, that affects the insurance industry directly. Let's take a look at the Consumer Price Index, which is perhaps the most well-known measure of inflation. This chart goes back to January 2007, just 11 months before the beginning of what's called the Great Recession, although probably it won't have that name much longer, as the current recession will likely be greater. But nonetheless, you can see that the general belief is that recessions force the prices of things down. In the Great Recession, prices rose for a little bit until about halfway through what turned out to be an 18-month recession. But then, as you can see, plunged dramatically to the point where on a year-over-year basis, they were actually negative for about 6 or 7 months. Year-over-year computation means that we take the price in a given month, compare it to the price in the same month a year earlier, and so what we're looking at is essentially a 12-month change, not a 1-month change in the price level. And this is done because things happen in given months. In Christmas time, the prices of some things rise. In summertime, the price of gasoline tends to rise. So doing it on a year-over-year basis tends to remove the distinguishing effects of activity in a particular month. So prices fell during the Great Recession, recovered pretty sharply in the months immediately after that recession, and then bounced around more or less until the most recent 2 months, in which, again, a year-over-year basis, inflation has receded to the point where in April of 2020, prices increased barely at all from their price level 1 year before. Now, next I want to throw in what's called the core CPI. The core CPI is the Consumer Price Index minus the effect of price changes for food and energy. And you can see in the orange line here, the core CPI is much less volatile, much more steady. In fact, since the end of the Great Recession, beginning in around 2012, core CPI has been very close to 2% on a year-over-year basis, pretty continually until recently, when it dropped to a 1.4% year-over-year increase. This is because the prices for food and especially for energy are quite volatile. And so when you take them out, the prices of just about everything else increase at a fairly steady rate. Now, because we're talking about an unusual period right now, I want to take a little bit of a closer look at the last 15, 16 months. This is 2019, 2020, the CPI in blue, the core CPI in orange. And again, you can see that the effect of food and energy can be so strong that it actually raises the general CPI above the core CPI for just a couple of months in the beginning of 2020. Now, where is the Consumer Price Index going? Well, we have the results of a survey of 53 econometric forecasters. I have charted their forecasts. These are quarterly forecasts, the best we can get from them, over the next 2 years. The orange shows the 1.4% for the first quarter. That's already in the can, as it were. And then for the next 7 quarters, we have forecasts. The forecasting survey averages the 10 most pessimistic, the 10 most optimistic, and the median, and I graphed them here, showing that the range is quite varied, but that for the second quarter of 2020, everybody just about is forecasting a drop in the prices of most things. The only question being how much of a drop are we looking at? The pessimists say it will be nearly 6%. The optimists say it will be a little more than half of 1%. And the median guess is somewhere in the 3% range. In the third quarter and onward, we see a return to a more normal pattern. The median forecast is 2%, pretty much on the way out through the end of 2020 and 2021. The optimists think that inflation will run a little stronger, and then the value of having a higher inflation is that if people perceive that to be the case, they are more likely to want to spend money now rather than wait to higher prices later. The pessimists also see prices rising after the third quarter of this year, but only at a modest rate, a little bit over 1 to 1.5%. And before we get too much further, there are a couple of major methodological issues that we have to be aware of in comparing the price range now and prices, let's say, a year from now. One is that there are some prices that simply can't be compared because the idea is that consumer prices today are being compared to exactly the same product or service in the prior period. So if we introduce a new drug and it has a particular price, we can't compare it to the same drug a year ago because the drug didn't exist a year ago, or a new service like a new medical treatment. We can't compare it because there was no such thing a year ago. So until we get a repeat usage of particular services, we really can't include them in the CPI or any subset of the CPI. And the other thing about the comparison is that if there are new elements to existing features, let's say you put, in an extreme case, seat belts on cars, and you charge more money for the car with a seatbelt than compared to the car without. The increase in price for the car with the seatbelt is not considered inflation. It's considered essentially a car with an extra feature. And so the Bureau of Labor Statistics, in its computation, tends to remove the effect of the new features or the new services. And in the case of the present situation, if we have new costs that are associated with fighting the COVID-19 virus, then that has to be removed from the price that is observed in order to calculate the correct inflation factor. In terms of insurance, there's one more thing to keep in mind in terms of computations, and that is that many major auto insurance companies are returning some of the premium as a refund in April and May, and possibly longer, depending on their observation of the impact of the virus and stay-at-home requirements on driving and accidents and auto repair. So the Bureau of Labor Statistics has essentially two different ways of handling this. If the insurance company refund results in a lower premium, if it's a deduction, then that's reflected in the price in a given month. If the refund is sent as a separate amount of money, which you could spend on anything, then that is not considered a reduction in the price of the insurance. It's considered a separate payment. And so the price can or cannot, depending on how the insurance carrier delivers the refund, be reflected in the price calculation. So with those things in mind, let's go on and look at the prices of the two types of insurance that are included in the CPI. One is private passenger auto insurance. That's the blue line in this graph. And tenants insurance, renters insurance, that's the orange line in this graph. Again, these are year-over-year percentage changes. Now, the thing I told you before about the effect of recessions on the consumer price index doesn't seem to have taken its effect back in the Great Recession of 2007 to 2009. Both prices for auto and tenants insurance rose pretty much throughout that period of time and kept on rising after the recession was over. In general, these two move pretty much with each other, although you can see that beginning in 2015, the price of tenants insurance dropped, in fact, down by 2017 to essentially zero increase, whereas the price of private passenger auto rose to, at one point, nearly 10% on a year-over-year basis. But the rise in the price of auto insurance wasn't really an inflation phenomenon. We had an unusual spike in the frequency and severity of auto accidents in the 2-year period from 2015 to 2017. And so this was essentially an attempt to work into the premium calculation the expectation that that spike in increased frequency and severity would continue. Obviously, it stopped in 2018. Prices then adjusted and have come down to the point where the change in tenants insurance, the most recent change in March, was essentially a small drop, 0.2% of drop in tenants insurance on a year-over-year basis. The drop in auto insurance, the 6.2% drop in auto insurance in April reflects the refund that insurance companies made to policyholders, reflecting the tremendous drop in traffic resulting from the stay-at-home orders in virtually every state, and the tremendous drop in the number of cars on the road, the number of accidents, and those refunds, 15 to 25%, were all applied in 1 month in April, and that's why you get the 6.2% year-over-year drop in the price of auto insurance in April. So that will either return back to a more normal level if there are no more refunds in May, or will continue to reflect those refunds. So now let's look at the things that contribute to the cost of property casualty insurance premiums, and one of them, essentially, as far as I'm concerned, contributes heavily to various liability insurance coverages, especially those that provide bodily injury liability, is prices for hospital services, which is what this graph shows you. I'm graphing both inpatient, that's the blue line, and outpatient hospital services, although as you can see, they generally tend to move pretty closely with each other. Again, on a year-over-year basis, in the last reading in April, both of them up about 4% over the same month in the prior year. They had been down about 6 months ago to near zero, and but that obviously seems to have been just a temporary move. So if bodily injury costs, as reflected from hospital prices, are going up, then you would expect that would have a direct effect on liability insurance claims and workers' comp claims in the property liability lines of business. Prescription drugs are the other major cost in the bodily injury liability area. These are, as you can see, quite volatile. For a time, we were looking at 4% per year increases. That dropped to zero in 2013, back up over 6% in 2015 and 16. So quite a swing from one period to another. Lately, they've been much more moderate, but one suspects that in a time of COVID-19, these could be quite volatile as well. Some of them probably not being prescribed because of the shift to focusing on the COVID-19 virus. Others perhaps rising in price because they are becoming scarce. Other things that affect auto insurance, we've got three contributing factors on this graph. Auto insurance repair, that's the blue line. Auto insurance bodywork, that's the orange line. And the price of parts and equipment, that's the green line. Parts and equipment are the most volatile of the three. As you can see, at one point up by 6% over the prior year. But in 2013 and 14, prices were actually lower in those months than they were the prior year. So quite a bit of variation there. Auto insurance bodywork and auto repair costs tend to be a little more stable, and both of them are running in the 2 and 3% range for the most part in recent times. So that's what the numbers on general inflation are as you remember. So not going to be driving the cost of auto insurance up terribly quickly at this point. In terms of wages, and again, this is the main cost of workers' compensation, but this is changes in median wages. And again, this chart raises a question about methodology and measurement. You can't always trust the numbers as such for what they seem to say. Median wages in the first quarter of 2020 rose by 3.4%. And so you may be thinking, boy, that's kind of a large increase in a time when the thought was that wages were not rising that fast. And the answer is that it's correct they were not rising that fast. The reason that median wages grew this high is that a lot of people lost their jobs in March of 2020. And the effect of that, many of them were low-wage workers. If the low-wage workers drop out of the calculation, what you're left is a median from a distribution of wages that is higher than otherwise. The median is, of course, halfway up from the bottom to the top. And so if some of the bottom disappears, getting halfway means you're going up higher. And that means that the percentage increase is larger. So this is a somewhat misleading number. 3.4% has to be understood as a number calculated as a result of low-wage workers not being in the calculation in the first quarter of 2020 as they were in many of the prior quarters when unemployment was very, very low and virtually everybody who wanted a job had one. In terms of homeowners insurance, one of the major factors contributing to premium rises in that is the price of single-family homes under construction. We're thinking in terms of the possibility of a home completely being destroyed by fire or windstorm or anything else. And if you have to rebuild the whole house, the price of your standard single-family home in 2019 went up by 3.1%. As you can see, that's down a bit from the 3 prior years, but still a fairly hefty rise, greater than the cost of living, and so therefore an effect on homeowners insurance covering the building, not tenants insurance. Finally, one of the major factors affecting insurance premiums is what insurance companies can earn on their investments. The chart goes back to the January of 2009, which is in the heat of the Great Recession. Since then, the interest rates on AAA bonds, the highest quality bonds that insurers invest in, have been generally drifting downward. The most recent rate available is a little below 2.5%. And so you can see that insurance companies are collectively receiving less in terms of investment income from their investments than they had been. And that means that in order to pay claims, they have to be raising their rates in order to collect enough money to pay those claims, especially the claims that are responding to inflationary pressures or the other pressures that we just described, which are pushing the prices of claims higher than the general cost of living. So that's our presentation on inflation. I hope you enjoyed it. If you have any questions, send them in. You can email me at stephenw@iii.org. Thank you very much.